Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Surabhi Upadhyay and Pavitra Parekh. And I was thinking of how do you classify this Monday morning, right? We're down 1% on the benchmark indices. And just as I was walking in, I was looking at the intraday recovery that finally we're seeing some recovery. The Nifty's recovered more than 90 points from the day's low. We're still down 1% on the benchmark indices. The Nifty has snapped a 9-day winning streak. And currently we're down 170 points on the Nifty. But the low today was at 10 a.m. And from that point, there has been a bit of a recovery. The culprit clearly is IT. Well, the Infosys stock itself, after 11-12% downside, is shaving away 80% from the Nifty. The Nifty is down about 165, 170 points, out of which 130 points is courtesy Infosys itself. Let's pull up that contribution plate, and you would see that Infy in itself is, resulting in a decline of 75 to 80 points on the Nifty. If you add to that an Infosys, Tech Mahindra, HCL Tech, Wipro, and you can pretty much explain the entire downfall today is courtesy the Indian IT names. Asia is actually performing a lot better today. So Chinese markets are up nearly 1%. We are expecting the Q1 calendar year 23 GDP estimates tomorrow. Economists are expecting a 4% year-on-year GDP growth from China, which would make it the best growth that we've seen in the last couple of quarters. And Hang Seng too is holding up by nearly about 1/3%. So Asia's okay.
Asia is okay. We're not that okay. And I think there are just two reasons why, Reema. You mentioned, of course, IT. And I think IT's just started the season on a pretty sour note, right? Usually we always say earnings season starts off with a flourish. And then, maybe the tail enders are not that great. This time it seems to be the other way around. We don't know. And in all of this, by the way, HDFC Bank's numbers have been practically forgotten. We were not even talking about it. But that was the better part in terms of the weekend results. But IT is where the action is. So that's one reason why the market took such a hard knock today. And the second reason is purely technicals, because in any case, we were running into very critical resistance zones around that mark of 17,800, 17,830 thereabouts. So anyway, that was a litmus test. And that's a tough sort of level for the bulls to crack. And then you get in a slam dunk from Infosys, and the result is on the screen. I think the point, Reema, that you raise is extremely critical, because in the last 9-10 days, the texture of this market has become a buy every dip, from a sell every rally to a buy every dip. And we need to see if that remains intact today. So if the bulls manage to stage a recovery and limit their losses and limit this decline, and the screen looks much better by the afternoon, then that would be a huge sign of hope. There's some semblance of buying right now, but it's not too much. I just want to mention the FPI buying before we carry on, because that's been the key trend of this recovery period. We're net positive for the month of March, and we're also positive around almost 8,000 crores of buying in the month of April as well. And that's reversing the massive 28,000 crores of selling in January and even the selling in February. So FIIs are buying, FPIs are buying. There we go. The bar charts are on our screen right now. And I guess, Pavitra, we really need to see if other sectors can come and support. I mean, banks were doing that, for instance, on Thursday when we went in for the long weekend. Yeah. But we need to see more performance, more heavy lifting from the others, whether it's Reliance or banks, to make up for the blues in the IT sector, I guess.
Oh, absolutely. And, right now, I think since we've gone through IT and banks and you've taken us through all of the bad news, if you still want to look for a little bit of positive, it is the fact that the broader markets are holding up so much better, right? Even on a day like this when mid-cap IT has come crashing down, you still have the mid-cap index, which is absolutely flat. Small caps are holding up as well. So that's looking a little bit better. That said, take a look at some of the mid-cap IT names and you'll see the kinds of cuts coming through pretty much across the board. But take a look at Coforge, or you have LTI, Mindtree, Persistent, all of these seeing pretty sharp cuts. Of course, HDFC Bank has slipped, but a little bit of green coming through on the consumption names today. Real estate as well today. By the way, the real estate index for the month is up almost 10%. You have the auto pack, which is up over 5%. So it's a little bit of green coming in on an otherwise very red Monday. But Reema, the main focus is on IT. So let's, start by talking about that. Like Reema has been telling us, ever since Thursday, really, it was a shocker in the fourth quarter. Earnings missed estimates on all fronts. But tell us what next. I mean, it's been a bad set. The guidance is terrible, but what next?
Well, I think the big question is, how long is this pain? Is it going to be short-term or is it going to be prolonged? Because consensus expectation is that in FY25, IT companies see a double-digit revenue growth. In FY24, we're going to see a single-digit revenue growth. Mid, high, you can analyze that. But in FY25, analysts are expecting a pickup and a double-digit revenue growth. Is there a risk to that? Secondly, expectations were also pointing for a recovery in margins in FY24 and FY25. Now, can companies flex the margin levers that they have on the supply side and post an improvement in margins? The problem is, as your revenues come down on account of the macro uncertainty in the issues and project cancellations and deferrals, the cost continues to remain very sticky. That's the reason why margins have been under pressure for both the IT companies that have reported. So the outlook on margins is going to be very, very crucial. But, particularly for Infi, just one more point, the company was a big overweight in most portfolios. MFs, domestic mutual funds, and the FPI holding, and those numbers will come up for you on your screen. The mutual fund holding as of December 2022 in Infosys was more than 17%, much higher than peers. Anyone who wanted to go overweight on IT would do it via Infosys because it was relatively cheaper than TCS and it was growing faster than TCS, and they just had more comfort in terms of the management commentary. Infi would give you a quantitative guidance. For TCS, you would never get a quantitative guidance. And secondly, look at the FPI holding as well, much higher in the case of Infosys at close to about 37%. So the impact of selling is seen a lot more if portfolios want to bring down their holding after this performance.
Okay, all right, that is the case on Infosys and what really could lie ahead. But let's now talk about the bull versus bear case because, as bad as the results might have been, it is really not the fact that across the board brokerages are negative on the stocks. We still have many which are positive. So let's introduce two brokerages now. We have HDFC Securities that has an ad call on the stock with a target of 1470, while Nirmal Bang is in the bear camp. They've lowered the target price to around 1200 rupees. Now, HDFC Securities is bullish on the thesis that Q4 can pass off as an aberration, even though macro headwinds still persist. And Nirmal Bang, meanwhile, says that they're bearish and they believe that on the macro front, the worst is really still ahead of us. So let me welcome on this show Apurva Prasad of HDFC Securities as well as Girish Pai of Nirmal Bang, who's actually in the studios with us. Girish, Apurva, thank you both so much for joining us. Girish, let me come to you first. You downgraded the IT sector a long time ago, so that call is absolutely bang on. But tell us from now, you're saying that in terms of macro headwinds, the worst is still ahead of us. In terms of what it could mean for the sector, how much worse do you think things could really get from here?
Yeah, so I think the issue, if you look at what has happened in 4Q, three months back, most TCS and Infosys management were fairly, I would say, cautiously optimistic on how the things would pan out in the near term. But the numbers have turned out to be far worse than expected. And that, I think, is an issue of lack of visibility. So my sense is that that visibility will still not be there unless you have the macro headwinds behind you. So as I've been saying, macro headwinds are ahead of you. I mean, we've still not seen the big event of the US recession or whatever it be, whether it is a shallow one or a hard landing or a deeper one. That is not behind us. So what we've seen is customers reacting in a certain way when US economy has been fairly resilient. If you look at what's happened in 4Q and what looks like a decent number in 1Q, consumers in the US have been fairly resilient. So when things turn bad, how will they react is something you need to kind of watch out for. And the one thing I would look out for, one parameter I would be looking out for is pricing. And if you look back in history, look at the various stress points the industry has gone through. Every stress point, macro stress point that the industry has gone through, we've seen pricing pressure. Thus far, we've not seen pricing pressure. So I would look out for that. I think it will happen. It just requires one large vendor to panic, and then we'll probably see that happening.
Would you liken this to the GFC and what transpired then in terms of weakness?
No, I think this is not like GFC. GFC was largely a BFSI situation, and obviously there was a very sharp decline, and then you saw the Fed come to the rescue. The problem that the industry is facing, which it's not faced ever in the last 20, 30 years, is the high inflation data, which prevents the Fed from going out and doing a very significant monetary stimulus, be it on the normal stimulus side or on the unconventional side. If that doesn't happen, I don't think the sentiment is going to improve, both on the corporate side as also from the P multiple perspective.
Girish, I think also, and correct me if the reading could be wrong here, but I think what's really also shocked the street is that this was two mid-sized banks. Perhaps we were working with the idea that, okay, there could be some sort of, maybe some delays here and there. We're not even in a full-blown recession as yet. Stock markets in the US are firing away. JP Morgan's earnings have been fantastic. We're not even in a real situation, a real problem. And then to see cancellations in Infosys' case, deferrals in TCS, but then cancellations. So is that why there's such huge disappointment? And I'm going to throw TCS's argument back to you. TCS said that at least customers in the US, they're very quick to turn off the tap the moment there's uncertainty, but they're equally quick to turn the flow back on. Now, do you buy that argument from TCS?
Yes, so I think visibility plays both ways. So probably in 4Q, you had a situation, the customer, where the vendors were kind of blindsided by the reaction of the customers. It could work the other way around too, but the point is it would work the other way around if the ground reality or the macro reality is changing for the better. Okay, as I keep saying this, we're not seeing the worst on the macro front behind us, it's ahead of us. And again, I think the other issue is about FY25. So right now, even I'm building in like a double-digit growth in FY25 because mine is an explicit call for a shallow recession. And I think that somewhere down the road, inflation will come down to 2% or below. And then we'll probably go into another round of a QE. And that is the reason why I'm assuming a double-digit US dollar revenue growth in FY25. Now, if that doesn't play out, there are obviously economists who are saying that core inflation in the US will probably not go below 4%. If that doesn't happen, then Fed is not going to go and do another round of a QE. If that happens, then you're going to see a very shallow kind of a growth kind of come through in even 2024 calendar year for the US economy. And then sales and profits of the US corporates are going to suffer even in 2024. So there is that challenge for FY25 that you could probably see consensus numbers come off. As you know, maybe it could be 6 months down the road. It could be like 9 months down the road.
So right now, this is from what you say, the reading that I gather is this is not really a two banks blowing up problem. This is deeper. This is about a slowing US economy, and this could extend into 2025.
Yeah, see, I think it wasn't so much about the bank. So if you hear the commentary, both the TCS and Infosys had said that even in the early part of the quarter, they had seen pressure. So it was a fairly broad-based kind of a pressure that's coming through. Interestingly, I heard Infosys saying that March was stable. I kind of wonder how that happened. And also, while the regional banks aren't a very significant exposure from an Indian industry perspective, they have an indirect, impact on the U.S. economy because apparently they constitute almost like 40% of lending to the U.S. in the U.S. economy. And if that kind of, I won't say collapse, but it kind of slows down very materially, then it has an impact on the U.S. economy, which then impacts your, Fortune 500 companies from their sales and profits and all that.
All right, got that. Let's also get Apurva Prasad in because he has quite the opposite view on this. Apurva, thanks for joining us. This is Pavitra. We were just going through the bear case, but you're clearly still optimistic on this one. It's a 3.2% decline in the constant currency revenue. You still have an ad rating, and you're saying that this quarter can perhaps, pass off as an aberration. So take us through your call on this. And also, this is at a time when Infosys is clearly saying that across verticals, they've seen deal ramp downs, not just deferrals, ramp downs. How are you still positive on this?
Sure. So while at the outset, I may want to state that we have also cut our estimates, and the Q4 performance was certainly not anticipated. I would certainly call this an aberration. Let me explain what I mean. So we were going with a flat sequential performance expectations. Against that, there has been a decline about 3.2% or so. Now, if you look at the guide, which is 4 to 7%, we were working with about 5 to 8%. That's what the number that we were expecting, a management guide. There's a bit of arithmetic here. If you look at the cuts that have come in, it's more a function of the exit rate of FY23, i.e. the Q4 performance as compared to the actual growth. Because if you look at what's implied in that 4 to 7%, if you see the midpoint, that's still at about a 2.3% CQGR. Now, this is an average of what they have delivered over the past 12, 13 years. So that's where we are. Which is what I meant by why Q4 seems to be an aberration. So while I agree that the macro-related challenges have only gotten bigger, but I think there are a lot of positives for the sector. So number one being, it's a very unique kind of a macro challenge that we are seeing currently. The labor market continues to be fairly tight. Even if you look at last month's number, it still continues to be above pre-COVID. Which is why it's unique, and it plays into the value proposition of a service provider. Second, the inflationary scenario, again, to an extent, it plays to the value proposition for a service provider, especially on the cost optimization side of things. And that's the commentary we are getting from the company. So while you are looking at a classic disconnect between the pipeline translating into bookings and bookings translating into revenue, let's not forget that Infosys also talked about the deal pipeline, which they see to be at an all-time high. I think that's pretty. I think that's encouraging for me. The fact that I would say the probability of them doing midpoint of the guidance is reasonably high, and I think also as an exception, I don't really recollect Infosys talking about margin trajectory beyond the year. So I think the fact that this is seen to be probably bottom levels, for margin despite guidance being lowered. I think that's another positive to look at. So I would say that the probability of getting to midpoint of the guidance is reasonably high. And at the same time, I do not see any structural challenge to the operating profile of the company.
So what would be your FY25 estimates, Apurva? If Q4 is an aberration and you're quite convinced that the company will at least be able to deliver the midpoint of their FY24 guidance, that's 2.3% revenue growth every quarter of this year, what can we expect for FY25 according to you?
Yeah, so
and what does this mean in terms of US macros for the company to be able to recover in FY25?
Sure. So we have our EPS is about 71 and a half, 71.7. We do expect them on top line to get back to double digit for FY25. And let me explain that. So let's say you do 2.3% CQGR, you hit midpoint of the guidance of 4 to 7%. Let's assume you continue at that rate in an environment where macros improve. But even if you continue at that kind of a rate, you get back to a double-digit trajectory. So there's a bit of an arithmetic there, but the point being is that you need to be growing at 2.3% CQGR, and that takes you back to double-digit in FY25. So that's what we're building. So from a midpoint of about 5% constant currency, we expect them to go back to double-digit in FY25.
Gentlemen, I want to ask both of you what this implies for the sector, because if the titans have suffered in this manner, if Infosys is seeing ramp downs, and I don't know how other IT companies in the bigger lot, the tier 2 and then mid cap, what lies ahead for them. So Purva, you want to take that up, and also just if you could elaborate on that point you made that you were seeing this as a 1 quarter aberration. What makes you confident that it's 1 quarter and the pain won't last longer?
So, Surabhi, if you see historically, and that's a good way to look at what's been the variability in terms of what the company sees themselves growing, what they end up actually doing, and what's been the variability of guidance throughout. So if you again look back last 15 years, from every time they've given out a guidance and where they've ended about 1.5% higher than the midpoint. Okay, that's one. Two, every quarter they do end up revising their guidance either upwards or lower. So 80% of the times that they have given their first guidance, the guidance has either remained unchanged or that's gone higher 80% of times. So that gives you some sense of variability, and this is across sort of cycles. What is giving visibility? The fact that Q1, Q2 are seasonally stronger from a large deal standpoint. The fact that if some of the deals that they do have in the pipeline that converts, that can give them the close to 2 billion net new large deal over the next 2 quarters, which should take them to the midpoint. So I think a large part of it is the fact that some of those bigger deals could convert. The fact that you see on the core part of their business, the core part which they report, which is X of digital, this is a segment which used to decline pre-COVID, and it's been more flatlined. So the deflationary part coming from the core services is not to the extent that it was pre-COVID. So I think that's another point which is going to be helping.
Okay, that is the bull case on this situation. And Girish, you heard that as well. Do you have any thoughts on what Apurva just said? And, of course, if you want to toss any questions as well.
No, okay, let me just step back and look at the sector. The companies are great companies. The sector has been a significant value creator for investors. My issue is differentiating the company, which is great, versus the stock performance, which I think will be modest and mediocre in my opinion. From a 5-year perspective, ignore the noise around hard landing, soft landing, all that is, it could be like a 12-month, 24-month kind of phenomenon. If you take a 5-year view, you need to understand what rate will this industry grow at. And I'm talking about tier 1 here. Yeah. My sense is that versus a 7% kind of rate of growth between FY15 and FY20, industry will probably grow 100 basis points or 200 basis points faster because of digital transformation related uptick and stuff like that. My sense is that margins could be coming under pressure over the medium term. And this has been the case for the last 15, 20 years. margins have been coming steadily under pressure. And especially for Infosys, I think one of the worries that I have of Infosys is that under Salil Parekh, while the revenue has grown quite fast, the EBIT growth has been actually along the lines of what TCS delivered. If you look at the EBIT CAGR between FY18 and FY23, it's pretty similar. So everybody keeps talking about Infosys growing faster, but that's been at the expense of margins. So those are some of the things that I could talk about. On tier 2, my worry is that the impact could be larger. I mean, it's a very idiosyncratic situation across various companies. But generally, I would say that the client exposure, the client concentration is far higher for the tier 2 companies. It just requires 1 or 2 clients to kind of pull back, and then your growth rates kind of come off very dramatically. The expectations are fairly high from what growth is going to be delivered by these companies. So, and the other thing is that last 3 years, I think there's been a significant margin expansion for certain companies. I think going forward, that could be a challenge for tier 2.
Okay, I think this has been a fantastic debate, and both of you gentlemen have been such good sports. So thanks very much, Girish, for stopping by and giving us your view. And Apurva, thank you as well for joining in. And let's see how this one plays out. Very interesting times ahead for Indian IT services. We will take a break on that note. On the other side, we come back with commodities and tell you what's making headlines there. Manisha Gupta joining in.
Welcome back. You're still tuned into Trading Hour here on CNBC-TV18. For the market, we're still seeing a 180-point cut, but we have recovered significantly from the day's low. The Nifty Bank has also seen a bit of a recovery, so now it's seeing just a 50-point cut. Names like Kotak Mahindra Bank have seen quite an up move right now at the high point of the day, almost 2% higher on that one. So there are definitely some names here which are moving higher. SBI as well at the high point of the day. So that's what's going on with the equities. But let's talk about the world of commodities as well now. Manisha joins us with all of the action that we're seeing in the crude space. Hi, Manisha.
Thank you for that, Pavitra. Well, yes, we're trading at a 1-month highs, and we've started yet another week on a positive note. $80 is holding for both of these commodities, and 85 is holding for WTI as well. And with this, we have gained nearly 8% for the month of April. While, of course, OPEC meeting did flag some downside risks to the summer oil demand, and that is the reason how they're justifying their output cuts as well. But apart from that, it is the Chinese crude imports that we've seen in the month of March up by 22% on a year-on-year basis, which is the highest since June 2020. That seems to be supporting prices at this point in time. Also, IEA says that they are anticipating a record demand in this year. Much of that would start building up in the second half of this year. But overall, on an average, they're anticipating 101 million barrels per day, which is 2 million barrels per day higher than the previous year. So good demand estimates keeping the prices in shape there. Also, Russian shipments have continued to decline. We've also seen cost of production in Middle East continue to go up. And then the markets also are looking at the exports from Iraq to Turkey also shut down. So that is nearly 400,000 barrels per day shut down for the last 3 weeks now, seems to be supporting the prices here. The markets everywhere seem to be now anticipating or waiting for the first quarter GDP numbers from China. That comes in tomorrow, and that would give you a further direction.
Thank you very much for that, Manisha. We'll slip into a short break. On the other side, we'll discuss market technicals. Rahul Mohinder joins in with his top trading bets.
Welcome back. You're with us on Trading Hour, and the market is still reeling under pressure, down about 1%. There's a bit of a fight back to lift up above the lows of the day. Rahul Mohinder is joining in. Rahul, thanks for being with us. Good morning to you. Well, bears have got a treat this Monday. For the bulls, it's a nasty knock. So what would you be advising? Buy this dip or stay on the sidelines? What are the levels you're looking out for?
Good morning. I think the last 10 odd sessions, we've really seen a straight line up, and there's no taking away from the fact that, after such a robust short-term rally, a correction like this can always be coming in. And, the point is there's a lot of nervousness because, I've been sensing that people really want to know, is this a breakdown? And, are we once again headed to newer lows? So I think that's a very quick conclusion. In my opinion, we've stabilized, in my opinion, till we breach a level of 17,550. I don't think there's any panic from a medium to long-term perspective. Now, what are we looking for in the near term is a level of close to 17,950 to 18,000. So that would be a target. And I think, yes, this correction can be bought into. And just bear in mind that 17,550 should be a key level or a stop loss on the Nifty spot. So that's the level to keep in mind, and the trajectory remains positive.
All right. And what about for the banks, Rahul?
I think if you look at the Nifty Bank, it's a bit of a similar story. Again, a very straight line up move. This one's probably outperforming a little bit. We've, virtually got back into the green even, as we speak. We're heading to that point where we might end this day positive. And when I look at the internals, the heavyweights being an ICICI, SBI, Kotak, when you look at these names, they still look fairly steady. And in my opinion, the strongest amongst these look Kotak Bank to me. And I think that would probably be on my buy list per se. But, coming to some stock specific ideas with the theme that, I'm trying to place that the short-term bull run's intact with that 17,550 stop loss. One would be Grasim. That's one stock which I am getting on my radar on multiple counts. So with a 1680 stop loss, one could look at short-term targets of 1755. Subsequently, above that, 1790 can even come in. Another very good calculated risk could be a stock like Bajaj Finance. Look at the stock where it's corrected probably a good 30% from its September 2022 peaks. And I can sense there's some good base building. The breakout that we've seen in price this month has been accompanied by fairly good above average volume. So one could look at buying into the stock, keep 5,800 as a stop loss, 6,150 as a near-term target. Finally, Tata Steel is another stock where I think medium to long term, one can't go, hectically incorrect for buying at these levels after the 18% correction we've seen from the January peaks. Keep a stop loss below 105, which I think is a very good support. One could clearly look at 112 as a target on it.
Okay, thank you very much for joining in. Another stock that we just want to quickly highlight is L&T. Now, while the top 4 Nifty losers are the IT names, the fifth one today is L&T. And remember, it gets a significant portion of its revenues now from L&T Technology as well as L&T Infotech. So I think close to about 30-35% of its revenues of L&T comes in from LTI as well as LTI Mindtree, and more than 40% of its profits come in from these IT services companies. Remember, IT services companies, because it's a service company, enjoy higher margins than L&T's margins, which is a manufacturing company and therefore lower margins in comparison. So therefore, the profit contribution is quite significant of these IT companies, LTI Mindtree and L&T Technology to L&T, which is why today one of the big losers is L&T. That's Larsen & Toubro's on account of weakening contribution coming in from these IT subsidiaries. Get into a break. On the other side, we'll discuss market fundamentals. Jigar Misri of Buoyant Capital joins us next. Welcome back. Mid-cap index is now back in the green. So not so bad if you strip out what's happening at the frontline level on account of IT. The mid-cap index has recovered close to about 200 points from the day's low. Anyway, it had not fallen as much as the frontliners, but now as you can see, the last tick on the mid-cap IT names, on the mid-cap index is actually in the green. And you've got gains. So you've got many of these banking names. RBL Bank is up 4.5%. UCO Bank has rallied 3.2%. South Indian Bank is up 2.5%. Bombay Dyeing has shot up on volumes and price action. So Bombay Dyeing today is up close to about 10%. IOL Chemicals has a big surge to its name. That's up nearly 8.5%. And a few of these fertilizer names like FACT, FACT, should also come up for you on your screen. You are seeing some strength over there. But banks are holding up pretty smartly, particularly at the mid-cap banking end. Jigar Misri, the co-founder of Buoyant Capital, is now with us on the show. Jigar, if it wasn't for the big weakness in the IT names, perhaps markets would be trudging higher today. Not by a whole lot, but at least it would have had a green tick. And we've had a good run-up in the markets. Do you think the risk-reward is now favorable for Indian investors to go ahead and buy? Would you recommend buying this dip?
Yes, good morning, Rima. Thank you for inviting me to your show again. I think we are actually reacting a lot to the news. So if we take a slight step back and, just realize that federal banks, the sort of central banks around the world have not really stopped their action vis-a-vis the tightening part. Yes, obviously when they increase the interest rates, your economy slows down, etc. is all known. Investments move a lot more to, stable currencies, and therefore FI outflows happen. That is known. But I think one of the less admired fact is the case that, they keep trying until something breaks. In 2006, if you remember, they increased the rate to 5%. And then we had a full 20% rally on S&P before the global financial crisis happened. This time around, what they've done is that, they've contained the SVB and the signature crisis to a whole extent. And therefore, the contagion has not been that pervasive, across the globe. In that backlog, if you look at India, in the last week of March, we had, a lot of people booking out tax losses. And therefore, a lot of smaller mid-caps were down and out. But I think in the rally that we have seen, you've seen a reasonably smart move, both on the broader indices, but more so in the underlying basis. Now, if I look at the markets from here on, right, and you look at the big sectors, there is not that much to frankly cheer at the index level. Now, assuming that, foreign flows will continue to remain challenged. In that scenario, banking, we have discussed that in the past, the broader adjustments have largely happened. We'll see most of these banks report in line, or the share prices will move in line with earnings growth, which is, I would say, 12, 13, 15% or thereabouts. Tech until today was clearly sort of higher on the 5-year average basis. Now we will have to cope with the fact that it will be a single-digit year for the next couple of years at least. Oil and gas, hardly anything to cheer. Automobiles has not so much been, earnings story as much as it has been what we used to refer to as an embedded valuation story. So PE investors have chosen to spray and pray. And then, valuations have increased, earnings are not really flowing through as thick and fast. So the bigger sectors are not really suggesting a scenario where earnings growth will leave a lot of comfortable area to operate around. And therefore, I think the play will more or less be in and around the small mid-cap names, where, company specifics, they were, yes, marred by the complete lack of liquidity. And that seems to have eased out. And I think a lot of these companies, as you were mentioning initially, are coming off their own as we discuss this.
Jigar, hi. Good morning. Good to have your thoughts. The sector we definitely want to get your views on is IT, because there's this huge debate going on whether you need to buy now to make money and generate wealth, over the longer term, or whether this could be a painful, longish haul in terms of, when things start turning around for the IT sector. What's your view?
Yes, so yes, I'd say, the fundamental difference that a lot of us forgot was that India does not really have tech, right? What we have is IT services, and both are fundamentally different in their cash flow and the ability to report very strong growth in numbers. With that in the backdrop, right, there was very little scenario or case to be made where, the valuations for IT companies in India expanded in line with NASDAQ, right? And obviously in 2022, they sort of corrected alongside them. There was no reason for them to go up and now for them to correct. In this sort of backdrop, and therefore 5-year average is sort of skewed because it had a good 2 years plus of something that in, at least our estimate should not have transpired. you take a slightly longer term view and look at the averages before that in a growth scenario, which was a lot more conducive, we did see multiples that were lower than what IT companies are reporting or are trading at today. And with that in the backdrop, it's difficult to make a case of aggressively going ahead and buying. There are a lot of these smaller IT companies which are niche businesses, which may make some sense or the other. The ones that we own is a company called Cyient. I don't track IT very closely. Viral from our team does, but from what we understand, they still have a reasonably good backlog. Yes, overnight the positive that has happened is a few banking numbers, JP Morgan, etc., were reasonably okay, and BFSI is a large exposure. So we are not rushing into buying IT just yet. There will be opportunities if the growth sort of span clears out. Then we may take a fresher call, but no hurry, so to speak.
Okay, that is on IT. Jigar, very quickly, any thoughts on the banks? We did have HDFC, which has been a little bit forgotten because of what's going down with the IT pack right now. But thoughts on the banking names?
Yes, Pavitra. So, the last time around, we did discuss that if you look at the 4 cycles of banking, the credit growth cycle, the NIM cycle, the credit cost cycle, and valuation cycle, I think we are fairly sort of there across in all of them. Credit growth has been reasonably okay. In that aspect, I think one needs to, keep this in mind that the difference between GSEC and Fed fund target rate at 150 basis points is the lowest we have seen in 23 years, right? And we have $280 billion of maturities, short-term maturities coming up in the next 9 months or so. So if part of that gets refinanced from India, then you could still have a reasonably strong and kicking credit growth cycle playing through. NIM cycle typically, peaks out once your interest rate hike peaks, and because banks tend to sort of reprice assets much faster than liabilities, and therefore NIMs expand when interest rates are rising, and obviously that becomes true when interest rates fall as well. So we might be at the peak of NIMs. It will again be a bank-specific issue, but broadly NIMs won't expand here, but they won't correct dramatically. Credit cost, which is the third cycle, I think has been holding out pretty well. For most banks, incremental growth has been led by retail for the past 5 years at least. And those don't sort of blow up en masse. And therefore, you'll not see a credit cost which is worsening. And lastly, valuation is one cycle which got played out very well, differently. So over the past 3 years, I would say the discount between an ICICI versus an HDFC bank, which was almost 70% at the peak, narrowed to something like 10-12% right now. If you include HDFC Bank consolidated, then it's as low as 3%. So I think all these things have played out, and a few investors who were brave enough even played this through PSU banks, and that has played out. From here on, if you look at HDFC Bank's numbers, I think the only disappointment has been in the revenue expenditure part, and they are actually opening up branches pretty fast, and that will eventually come up to play. So if I look at a correlation of share prices to say something like an NPL vis-a-vis say a RevX, I think the correlation to share price is much lower for RevX, and therefore it's not a huge case of worry regardless. This bank is now attracting something like 20% of incremental deposit, 1.5 lakh crores. That's a huge number. And eventually they'll go out. I understand that's because part of it is merger related, but eventually they'll create a slate which they can lend against, and therefore it makes a very strong case for this bank to start gaining its exposure again, and start claiming its top spot.
Got it.
Yeah.
Jigar, we are unfortunately running out of time, so we'll have to wrap it up for today. But thank you very much for your thoughts and views. We'll take a quick break. On that note, more on the markets on the other side.
Welcome back. You're still tuned into Trading Hour, and we have an exclusive for you now. Sources are telling us that the IRDAI, the insurance regulator, has revised its plan to launch the Bima Sugam that was actually said to be an Amazon-like platform for insurance products. So Yash is here with the details. Yash, what are you picking up?
Well, that's correct, Pavitra. So there was, of course, evident excitement around this new platform. But for a very long time, it seemed like the plan was almost forgotten. But what we've been given to understand now is that the insurance regulator has once again looked at the plan again. It has sort of tried to revive this particular Amazon-like platform called Bima Sugam for sales, servicing and claims of insurance policies. What we've been given to understand is that IRDAI chairman Debashish Panda very recently met life insurance and general insurance CEOs, all of them. And what happened in this long meeting is that a broad, framework for this particular plan has been designed. This is, of course, a basic framework, but a very important one. We've been able to pick up some details as far as this particular plan is concerned for the revival of Bima Sugam. What we've been given to understand is that the insurance regulator is soon expected to release RFPs or requests for proposals when it comes to appointing a service provider, when it comes to this particular platform itself. As far as Life and General Insurance Council and the companies, Life Insurance and General Insurance companies are concerned, they will own about 45% stake each in Bima Sugam, which means every life insurance company, every general insurance company will have an equitable stake out of that 45% lying on each side. The balance 10% stake is expected to be held by service provider, insurance aggregators, as well as the insurance agent body. As far as the capital is concerned, the plan is to raise about 100 crore of initial capital to start this particular exchange. And one concern was how would the exchange raise money when it comes to its operational expenses. Here, what we've been given to understand is that one of the suggestions is that on every transaction, which is sale, renewal, claims, there will be a particular fees which the insurance company which will have to pay to the platform, that is Bima Sugam. Not just that, on every inquiry as well from a policyholder, a particular amount will have to be paid by the insurance companies to Bima Sugam, and the implementation of Bima Sugam will happen in 3 phases. First one will be providing data to insurance companies. Second one, allowing standard or basic products on the platform. And third one, allowing all life insurance and general insurance products on the platform.
Thank you very much, Yash, for that. Need to slip into a very short break. We'll come back with more on the markets.
Welcome back. Here with us on Trading Hour, and the story from the street continues to be pretty similar, still down about 1%. Not much has moved on that chart in the last 1 hour that we've been here in the studio. Infosys, by the way, is still nursing a very similar losses. So while the rest of the market is trying to fight back, the buyers are simply not emerging on an infy, not at least right now. And the same holds true for the entire frontline tech pack. It's just FMCG stocks that are fighting on the upside today. So Lever, Nestle, Britannia, ITC, these are the biggies that are trying to pull things up on the other end. But right now, advantage bears on the street. With that, we're completely out of time on this edition of Trading Hour. Many thanks for watching. Do keep it with us. All the action continues. Up next is Halftime Report.